The other day we talked about what happens when your house burns down or gets lost in a flood or a hurricane. Do you still have to pay your property taxes? Do you still have to pay your mortgage? Well, today we're going to cover the same sort of thing but for renters, because a lot of people are wondering also, do I still have to pay my rent if my rental apartment or my rental house burns down? And with this one, the answer to that question is actually not as clear as it is with the property tax and mortgage issue. So let's dive into this and check out some scenarios that might dictate whether or not you're still on the hook for rent. And funny enough, the deciding factor of whether or not you are going to be on the hook for rent is how destroyed is the property. Obviously, if it's a complete loss, if it's totally destroyed and the building's not there anymore, like what happened with a lot of people with these fires, then you're not going to be on the hook for the rent anymore. But the gray area begins when the building is still there, maybe just has some fire damage. And it doesn't even have to be fire damage. This pertains to other natural disasters too. Just like a hurricane, for example, number one thing that people experience with hurricanes is flood damage. So how unlivable is the property essentially is what this comes down to. Now in California, where all the fires are taking place, under California law, you are immediately released from your rental agreement, and landlords must return any prepaid rent and refund the security deposit within 21 days if you lived in a property that has now been completely destroyed. And the same rules apply if your rental is partially destroyed but is still deemed unfit to live in. And in this scenario, you can either choose to terminate your lease or stay on the lease and move back in once the landlord makes the necessary repairs for the property to be livable again. But you are not required to pay rent while the repairs are being made. This is where the gray area kicks in, because if your place is partially destroyed but it's still livable, you are still responsible for the rent payments and possibly even some of the repairs. Because in some leases, it will outline who's responsible for what in terms of repairs, and so this could put the tenants on the hook for repairs from this fire damage. But obviously, if you don't do it, then eventually the landlord's going to have to do it if you don't move out, but expect to lose your security deposit for sure. But here's the thing, who decides if your rental is unfit to live in? Because at the end of the day, somebody's version of what's livable and what's not can be drastically different from someone else's. So basically they look at it like this. It has to meet habitable conditions. And this is a term that's used across the board, pretty much across the country, that includes regulations that keeps units free from structural issues, pests, and working utilities. It can also include things like the condition of the roof, the status of the plumbing, and is the stairway usable, different things like that. But the answer to the question of who is in charge of deciding whether or not the unit is livable is really, you guys have to kind of decide yourself, right? And basically the tenant and the landlord have to agree that the place is livable or not livable. And if there's a dispute, then it needs to be taken to court, unfortunately. And here's another thing too that people need to think about, which would also apply to people who lost their home in a fire if you own the house as well, is do you still need to pay your utility bills? Now, when it comes to renting, it all depends if the utility bill is included in your rent or not. Because if you have all your utilities, or at least some of them, included in your rent, and if you're off the hook for paying the rent, then you're also off the hook for paying those utilities. But if you have utilities in your own name and your own accounts set up, then it kind of depends on where you live and the condition of your rental going back to that. Southern California Edison, which is one of the power companies in California, they recently announced that they're going to be suspending billing for all of the customers who live in a mandatory evacuation zone in California. Also, Southern California Gas going to be doing the same. But if the house is completely destroyed, there's no reason to have any utilities attached to the property, then you need to make sure that you at least shut those accounts down or put them on pause indefinitely, so that way you're not being billed for a house that isn't there. And the same is true for a rental. If you had to move out and say you're partially damaged and the landlord is going to make repairs and it's going to take 3 months, let's say, and you're out for 3 months, make sure you put your electric bill, your internet bill, and different things like that on hold. And I'm sure most of these companies are going to work with you, especially knowing that you are a fire victim, they won't charge you guys. And you can just turn those services back on once you move back in. Another big one is, can the landlord raise your rent after the property has been damaged? So first of all, if you have a lease, then you shouldn't have to worry about this because the terms of your lease don't change. So even if there is damage to the property and you have to move out for a couple months and then you're going to move back in, your rent is not going to go up. But remember that once the term of the lease is over, then your rent is subject to go up even under normal conditions. And right now, with the price gouging laws in effect in California, they can still increase your rent by 10% and still be within the law. So let's say you just had partial damage to your place and it's going to take up until April for you to move back in, and your lease is up in May. By the time May rolls around, they can actually raise your rent, and that will be perfectly legal to do. And the truth is, I would be expecting it at this point. If you are a tenant in California that has a partially damaged property and you have to move out and the landlord has to make some expensive repairs, it's almost a guarantee that they are going to raise your rent to recover some of those costs once your lease renewal is up. But another big question mark with all of this fire damage is, how much is it going to cost to rebuild all these houses? This is obviously a big unknown right now, but there are some estimates. And right now, it's estimated that a little over 12,000 structures have been completely destroyed, and we don't know yet how many of them were homes and how many of them were commercial. And the loss estimates are likely to continue to rise until all of the fires are completely over. But as of Tuesday this week, it is predicted that the insured losses are up to $40 billion at this point. This is insured, okay? And keep that in mind too, because we've already heard figures of the actual losses well over $250 billion. But only $40 billion of that is insured, guys. So a lot of people are going to be on the hook for a tremendous amount of uninsured losses with these fires. And this is by far the largest wildfire event in history. And the previous wildfire event in California went over a little $11.5 billion of insured losses. That was the Camp Fire back in 2018. So this LA fire completely dwarfs that one, not only in terms of size, but also the amount of loss here. Now, in the Pacific Palisades, which was a very expensive area, the median home price was $4.7 million right before the fire. And in Altadena, it was about $1.3 million. But most of the price that you're paying for these properties is the land value. That's where pretty much all of the value lies in most of these properties. It makes up about 78% of the total property value. So they estimate that the total rebuild cost for a house in the Pacific Palisades would be about $947,000, and about $262,000 in Altadena is after deducting a 2% profit margin from the builders. But there's also a lot of other unknown costs that we're not sure how much that's going to cost yet. Things like the cost of debris removal and where are they going to put all this debris also. Then you have site remediation, getting the property ready to rebuild on and safe to rebuild on. You also have the repairs to roads and utility services from the areas that were affected. So there's a lot of stuff that goes into rebuilding. It's not just as simple as throwing another house up. There's also a lot of uncertainty around how many people will even be in the position to rebuild, right? Because they're going to have a confluence of things happen. They either have to have the money to do it themselves, especially if they're uninsured or most of it is uninsured, or they have to rely on the insurance company to come through, which can take an extremely long time. And if a lot of these people end up deciding to sell their property, well, then a flood of new listings can also bring these property values down pretty tremendously, which is kind of ironic because Gavin Newsom just put in an executive order in California that is essentially outlawing people from receiving ultra lowball offers on their property. You can't have these vulture investors essentially trying to steal your property from underneath you in a vulnerable situation. They even go on to say that this is going to be a prosecutable crime if you're caught doing this. The executive order features a 3-month barring of any unsolicited offer to an owner of real property located in the zip codes affected by the wildfires. It also bans people in LA from purchasing or acquiring any interest in the real property for an amount less than fair market value of the property or interest in the property prior to the fires breaking out. According to Newsom, he's already heard complaints from numerous homeowners over there that have received unsolicited and predatory offers from speculators offering cash far below the market value of these properties. So this executive order is retrospective, going back to January 6th, the day before the fires started. So here we have a house with a very extensive history in terms of trying to rent it and sell it. They've been trying to rent it and sell it since early 2022, so practically 3 years now, starting off asking $18,500 for rent and starting off asking almost $2.7 million for sale. And then now, fast forward to today, they are down to $1.8 million for sale. Okay, so they dropped the price $900,000 on this house, guys. And it doesn't say here if it's still listed for rent or not, but that is a massive price cut, almost $1 million, and the house is still sitting here for sale 3 years later. This is exactly the perfect example of how not to sell property. So people in California are going to be in trouble in general when it comes to rebuilding, not only because of the cost, but also because of the sheer amount of uninsured losses. And we saw a lot of insurance companies pull out of California over the past couple of years. And if they didn't pull out, they severely reduced the amount of homes that they insured at any given moment and threw a lot of people on the California Fair Plan, which is pretty much identical to what happened here in Florida a couple of years ago. We saw a pretty strong hurricane back in 2022, Hurricane Ian, and the policies for Citizens Insurance skyrocketed here to about 1.5 million policies at one point. And now, at the beginning of 2025, they've been able to lower it just under 1 million. It's sitting at around 900 something policies. So they've had a lot of success bringing insurance companies back into the state, but that's a whole nother can of worms that I covered in this video. I'll put up on the screen here, because basically a lot of these companies that are coming in to insure properties here now in Florida are what they call non-admitted. So if you're curious to know what that means and how that works, go and check out that video. But now California is in the same boat. They have a lot of people on the California Fair Plan, but obviously there's probably not going to be enough money in the California Fair Insurance Plan in order to pay for all the damages that have been done and all the people who have been affected by these fires. And there was a recent law change in California that allows insurance companies to bill their customers if they are forced to bail out the plan, which has an estimated $200 million in cash and $2.5 billion in reinsurance. So looking at the amount of insured losses right off the bat, they're probably going to go bankrupt, if not go pretty close to bankrupt. But just like how it works here in Florida, these state-run insurance companies don't actually go bankrupt. It's impossible for them to. Instead, what happens, everybody else has to pick up the slack. Right now, the estimated losses that are covered under the California Fair Plan are sitting at $6 billion. So it is going to probably go far beyond what they actually have in reserves and in reinsurance. You can see by looking at this chart here just how many people have been pushed to the California Fair Plan just in the past 4 years. So basically what happens if the Fair Plan pays out all of their money and uses up all their reinsurance, then the state can call on commercial home insurance companies to pay the rest of the claims by imposing what's called an assessment on the companies. And the charge on each company would be proportionate of its share in the home insurance market. So if they lose more than $2.5 billion, they are going to have to call in an assessment, which is almost a guarantee at this point, considering the estimate is at $6 billion. So now insurance companies in California can add 50% of their first $1 billion of an assessment to their customers' bills, along with 100% of any amount over that. Anybody in California who pays insurance, even if it's not with the Fair Plan, is likely going to see a pretty sizable increase due to this situation, guys. This is basically worst case scenario. This is something that I thought for sure would happen here in Florida before it ended up happening in California, but apparently not. And they were already talking a 30 to 40% increase in insurance premiums for people in California before this fire. So now that there's probably going to be assessments on all of these insurance companies, you can guarantee it is going to be substantially higher than that. Who knows? It could be 60, 80% higher within the next year. In fact, I wouldn't be surprised if this situation puts California now in the top spot, even surpassing Florida, of the most expensive homeowners insurance in the entire country, because this is such a massive disaster and the losses are so huge that they are going to be coming after their policyholders to recoup these losses. You can guarantee it. And then you have, consumer advocates over there that are, freaking out over this situation because of the amount that homeowners insurance bills are likely to go up over this. And they say that homeowners across the state shouldn't pay because the insurance companies dumped homeowners on the FAIR plan. Well, it doesn't really matter what should or shouldn't happen, because that's how the law is written over there now, and whether or not it's right, this is how it's going to work out. And think about how lucky these insurance companies got, right? All these insurance companies that dropped coverage and dropped a bunch of these people, thousands of people lost coverage over the past year in California. A lot of them right in these fire zones, specifically lost fire coverage, and now this, right? So the insurance companies hedged their bets on that one, and they have won big time. And now they're even talking about how it's possible that the state could end up bailing out the FAIR plan and issue bonds to raise cash for the plan. And the FAIR plan could also seek recovery money by suing utilities that can be shown to have sparked one or more of the fires. So there's also going to be a bunch of lawsuits coming from that too, now that there's video footage showing that some of these power lines did in fact start some of these fires. So it really is just a nightmare scenario for people who are dealing with this right now. Just thinking about how long it might take for these claims to go through. Anytime there's a big natural disaster like this, the claims process is an absolute nightmare because of the backlog of claims, and they have to have adjusters to verify the claim and make sure there's no fraud and make sure everything is legitimate, right? But my question is, why isn't the governor over there putting in an executive order forcing insurance companies to expedite getting these claims paid out? I don't know if he can even do that or not, but they should be using some of those resources they have over there towards this. California collects more in taxes than any other state in terms of state income taxes. It's supposed to be one of the richest states in the country, yet is running this massive deficit right now, which is one of my huge pet peeves about California, and one reason why I will never move there until any of that stuff is fixed, right? But I do like spending summer there because nowhere else in the country can you see 70-degree days day after day and not have it being swelteringly hot. So if you are one of these homeowners that does end up getting your claim denied, or you're somebody who does get your homeowner's insurance canceled, what are you supposed to do? Well, there are some reasons why a insurance company might deny your coverage, and here's a few of them. Your area has widespread losses, the insurer leaves the market or your state in general. We've seen a lot of that in California and Florida. You failed to make insurance payments in the past. You filed too many home insurance claims. That's a big one. Check out these classic cars behind me. They could also deny you because your credit score is too low. They can deny you because you have financial risks like a high claims history. They can deny you for your home being too risky to insure. They can even deny you coverage because of the type of dog you own. Now, if you were rejected getting homeowners insurance, the most important thing for you to do is to find out the reason. You have to find out why you were denied. And you have to ask the insurance company to reconsider your application, or if you can adjust your coverage. You can also request quotes from additional insurance companies. You can ask friends and neighbors which insurance company they use. You can make some necessary improvements to your home to lower the risk. You can improve your credit score. Funny enough how that plays into getting insurance. You can also take out a surplus line policy if you've been denied by numerous insurance companies. That sounds expensive. You can also go with the insurance of last resort, like here in Florida it's Citizens, in California it's the FAIR plan. And you can also file a complaint or contact a lawyer if you think you were unfairly dropped. And to be totally square with you guys, none of these options sound very appealing if you're somebody that gets denied coverage. Unfortunately, it's going to be probably a very stressful uphill battle in getting coverage and finding out why you were denied and all of this if this happens. So it's not a good situation to be in. This brings me to my final point, that people just need to start realizing the growing reality that more and more properties are going to be uninsurable in the future. And if they are insurable, the premiums are likely going to be so high that it's basically like it is uninsurable unless you're wealthy. That's the direction that we're moving in these high risk areas. And a lot of people are on board with that. You know, the rest of the country is tired of seeing their insurance premiums go up because the insurance companies have to continually bail out people in high disaster prone areas that continue to get wiped out, like here in Florida and California and Texas and Louisiana. So it probably is fair for people who want to live in these areas to take on a more sizable responsibility and a bigger burden when it comes to the financial side of things with insurance. Why should everybody else have to contribute towards people that want to live in these expensive, highly disaster prone areas? They shouldn't. Which is why I'm telling you to get prepared for the fact that a lot of property is likely going to be uninsurable within the next decade. You're going to see it come to a situation where most companies will not even touch it, and if they do, the premiums are going to be so cost prohibitive that it's like you might as well probably not even carry insurance. Pretty much what it's going to come down to. Which also means that if you own a property like that, you better make sure you own it free and clear, because that's going to be the only way you're going to be able to actually live into that situation. You can't own a property and have a mortgage and have no insurance on the property. Your lender will put a forced place policy on that home for you, and it will cost you even more than it would if you were getting it in the private market. So this is the direction things are headed, guys. Uninsurable properties here in the United States. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.